In 2025, the phrase Trump tariffs 2025 became more than a headline. It became a reality shaping everyday life. On April 5th, the United States officially began collecting a new 10% baseline tariff on imports. By August 7th, those tariffs had escalated into a much broader system, ranging from 10% to 50% on goods from key trading partners, including Canada. What sounded like a bold political move in Washington quickly turned into something far more personal for American families. Because tariffs are not just about trade disputes or diplomatic battles, they are about your wallet. They influence the price of the lumber used to frame a home, the steel in your car, and even the everyday goods in your local store. The promise was simple: bring back American jobs and protect domestic industries. But the question is whether the price of that protection is now being paid by the very people it was meant to help. This is the starting point of the Trump tariffs 2025 story. And it's why we need to look beyond politics to understand how these tariffs are reshaping both markets and households in real time. Why lumber? A trade dispute that never ends. When we talk about softwood lumber duties 2025, we are not talking about a brand new fight. This dispute has been running for decades, resurfacing again and again, because the United States depends heavily on Canadian wood. Nearly 70% of the softwood lumber used in American homes comes from Canada. That means every time Washington raises tariffs, the ripple spreads quickly through the construction industry and into the wallets of families planning to build or renovate. The argument usually centers on whether Canadian producers have an unfair advantage. Much of Canada's timber is harvested from Crown land, land managed by the government, and sold to mills at prices the U.S. industry believes are too low. To offset what they see as subsidies, the U.S. applies two types of trade measures: anti-dumping duties, AD, and countervailing duties, CVD. In simple terms, anti-dumping duties are used when goods are sold below market value, while countervailing duties are added to neutralize government support. Think of it this way: if Canadian lumber is judged to be too cheap, Washington slaps on a tax to balance the playing field. The problem is that this balance is rarely felt by producers. Instead, it shows up in the cost of new homes, repairs after storms, and even the price of small backyard projects. So while the softwood lumber fight may look like a battle between Ottawa and Washington, it is really a dispute that ends up being settled in American neighborhoods, one 2x4 at a time. The 2025 duty update, numbers that matter. On August 8, 2025, the U.S. Department of Commerce released its final ruling on Canadian softwood lumber. The decision set countervailing duties at rates between 12.12% and 16.82%, depending on the producer. At the same time, the preliminary results for anti-dumping duties suggested a combined rate that could reach around 34.45%. It is important to stress that this 34.45% figure is preliminary and still subject to review. But even at these levels, the duties represent a major escalation compared to the averages of 2024, which hovered in the mid-teens. In other words, tariffs on Canadian lumber have nearly doubled in the span of a year. For television viewers, here's a quick snapshot to keep it clear. CVD final, August 8, 2025. 12.12%, 16.82% AD preliminary, 2025. Approximately 34.45% combined 2024 average duties, approximately 15% to 18%. The math matters because these numbers flow directly into the cost of building. When tariffs climb, the price of wood rises, and that cost eventually lands in the budget of American homeowners. It is one of the reasons experts warn that housing affordability will remain under pressure as long as these elevated duties stay in place. So while duty percentages may sound like dry policy on paper for families saving to buy or rebuild, they translate into thousands of dollars in higher expenses. Canada's countermoves, money, markets, and homes. On August 5, 2025, Ottawa announced a 1.2 billion Canadian dollar support package aimed at helping Canadian lumber producers absorb the impact of U.S. tariffs. This funding is designed to keep mills running, protect jobs, and provide credit to smaller operators who might otherwise struggle under the weight of new duties. But financial aid was only the first step. Canada has also tied this package to a much larger housing strategy at home, with more than 25 billion Canadian dollars in loans and financing committed to expand residential construction. That means the same government that is helping sawmills survive is also fueling demand for lumber inside Canada, ensuring producers have a steady domestic market to rely on. At the same time, Canadian officials have been clear. They do not intend to wait on Washington for relief. Instead, they are working to diversify exports, seeking new buyers across Asia and Europe. The message is unmistakable. What was supposed to be pressure from tariffs has become an excuse for Canada to invest, modernize, and broaden its reach. Rather than retreat, the country has used the trade fight as leverage to strengthen both its housing sector and its global trade position. This kind of Canada retaliation shows how quickly policy battles can backfire. While Washington raises tariffs, Canadian lumber producers are adapting, finding new markets, and building resilience that may leave them stronger in the long run. The price impact, from lumber index to living rooms. Numbers tell part of the story, but it's when those numbers hit families that the reality of tariffs becomes clear. According to the National Association of Home Builders, the lumber composite index has risen 11.6% year over year. At the same time, the producer price index in July climbed 3.3%, showing how higher costs are spreading across the entire materials sector. For builders, these figures mean more expensive frames, panels, and roof trusses. For families, it means the dream of a home is drifting further out of reach. Consider one example from California. A family rebuilding after a wildfire discovered that the extra cost of lumber alone added $35,000 to $40,000 to their reconstruction budget. That's not an upgrade to marble countertops or a luxury deck. That's simply the price of wood. The same math applies across the country. On a new home with a $350,000 budget, tariffs and rising materials can push the total cost up by an additional $35,000 to $50,000. That's enough to price thousands of buyers out of the market or force families to scale back their plans. This is why analysts warn that housing affordability 2025 is not just an abstract debate. It is a day-to-day struggle that ripples through mortgages, insurance claims, and disaster recovery funds. The effect doesn't stop at the front door either. When fewer homes are built, construction costs 2025 spill into lost jobs for builders, slower appliance sales, and weaker demand in local economies. From indexes to living rooms, the impact of tariffs is already here, and it is shaping how Americans live, rebuild, and invest in their futures. Who really pays? Competing views. When it comes to the impact of lumber tariffs, the debate is sharp and often divided. The National Association of Home Builders, NAHB, argues that every new home in America now costs an additional $9,200 to $10,900 because of tariffs on Canadian softwood lumber. They point to higher invoices for framing materials, sheathing, and other wood products that flow directly into the final price tag of a house. In their view, these added costs are forcing many families out of the market, slowing housing starts, and weighing heavily on affordability. On the other side, the U.S. Lumber Coalition pushes back hard against those numbers. They insist that NAHB's estimates exaggerate the effect, noting that multiple factors, from labor shortages to mortgage rates to broader supply chain pressures, also contribute to rising home prices. According to them, blaming tariffs alone for the entire increase distorts the picture. The reality is that both sides are partly correct. Tariffs are not the only reason home prices climb, but they are a powerful one. The truth lies somewhere in the middle. Other pressures matter, but tariffs magnify those pressures and accelerate the cost spiral. And in the end, there is no escaping who bears the burden. Whether you agree with NAHB's calculations or the coalition's counter-argument, the final bill lands in the same place, with the American consumer. Families saving for a down payment, communities rebuilding after disasters, and buyers stretching their budgets are the ones truly paying for this policy fight. That is the unavoidable consequence of lumber tariffs, no matter which side of the debate you believe. Can America replace Canadian supply? One of the loudest promises behind the tariffs was that the United States could simply produce more lumber at home. But the reality of U.S. lumber production tells a different story. Building a new sawmill is not like flipping a switch. Industry experts note that it takes 3 to 4 years to bring a mill online. from securing permits to arranging financing to hiring skilled workers. Even then, it requires major capital investment and a steady flow of logs, which many regions cannot provide at current levels. That is why nearly 70% of softwood lumber used in American construction still comes from Canada. It is not because the U.S. doesn't want to be self-sufficient. It is because the capacity simply doesn't exist in the short term. And without that capacity, tariffs don't solve the supply problem. Instead, they tighten it. With fewer imports flowing across the border and no quick way to replace them, builders face shortages and escalating costs. The result is straightforward: higher home prices, fewer housing starts, and ripple effects across the economy. When new construction slows, it is not just families who pay more. It also means fewer construction jobs, reduced demand for appliances, and less business for real estate agents, lenders, and local suppliers. So the idea that America can replace Canadian supply in the near future is more wishful thinking than realistic planning. Until new mills are built and running, a process measured in years, not months, tariffs will keep pushing the cost of housing up while leaving both workers and buyers caught in the middle. On August 19, 2025, S&P affirmed the U.S. credit rating at AA+, citing the revenue boost from tariff collections. That might sound like a victory on paper, more tariff revenue flowing into government accounts. But the numbers tell a more complicated story. In July alone, the federal deficit still hit $291 billion, despite all of those new tariff dollars. This is the paradox at the heart of Trump tariffs 2025. Yes, the government takes in more money, but the cost of that revenue is pushed onto families and businesses. For Washington, it looks like a gain. For Main Street, it feels like a loss. When tariffs drive up the price of lumber, steel, and everyday goods, it is not politicians or policymakers who foot the bill. It is the homeowner trying to rebuild after a flood, the builder forced to scale back projects, and the buyer priced out of the market. So as we step back, the bigger picture becomes clear. Canada has used this dispute to invest, diversify, and strengthen its position, while the United States faces higher housing costs and slower construction growth. In short, tariffs meant to defend American industry are, for now, weakening affordability at home. And that leads us to the key question: if these tariffs last another 2 or 3 years, what kind of housing market will American buyers be facing? If you found this breakdown helpful, be sure to subscribe, hit the like button, and share your thoughts in the comments. Your perspective matters, and it helps us keep exploring how policies like Trump tariffs 2025 shape our economy and our daily lives.